Ladies and gentlemen, please join me in welcoming our Global Economics keynote presenter, Constance Hunter, Chief Economist and Principal at KPMG.
Hi, everyone. It's wonderful to be here with you. I'm Constance Hunter. I'm the Chief Economist at KPMG, and I am happy to give a little overview on the global economy and then be joined by two wonderful economists where we will have a discussion of all things economic, COVID, and we will allow you to ask some questions. So if possible, I would love to have my slides up, please. So the title of my talk today is Economic Growth in a Time of Disequilibrium. And I'm just going to unpack this slide for you. It may take you back to your economics classes in college or grad school. So if we look at the two solid lines here, and where they intersect is a large black dot, and that's where supply and demand meet. And this is what we call equilibrium in economics. Now, because of the pandemic, what happened is we had the demand curve shift up and to the right for goods. Goods consumption really increased around the world throughout the pandemic because people could not consume services. They couldn't go to baseball games, they couldn't go to weddings. And so what we saw was this increase in demand. Likewise, at the same time, because of the pandemic, supply chains were hampered. There were shutdowns and are still ongoing shutdowns around the world as factories cope with outbreaks of COVID and try to stem those outbreaks by reducing the number of employees and then at times closing down due to the virus. And so we've actually, instead of having supply move down and to the right to meet that excess demand, we've actually had supply contract in some cases. And here we have that red dotted line, the disequilibrium, right? This is not a normal economic response. And so we're seeing this impact the global economy and cause what we would call in economics frictions. So eventually, of course, we expect that supply curve to move down and to the right, produce more quantity, allow prices to normalize, and that green dot there will be the eventual post-pandemic equilibrium. And what I have just explained to you is the technical ways that economists view these price increases in many cases as being transitory. So let's move on to the next slide, because we know that the virus is very much dictating the outcomes. And so if we look here, we can see that the vaccine rollout, those are the bars, is highly varied around the world. And then in places where the vaccine rollout is lower, so if we look at some place like Brazil, for example, or even Japan, where they've had a spike up in cases, we definitely see continued vulnerability to the virus. And if we look at the next slide, what we can see is that at the next slide, we will notice, if you go to the next slide, thank you. The next slide, we can see that the growth trajectory, as outlined by the OECD, very much depends on the trajectory for the pandemic. So this was work that the OECD did in March. It was before cases started spiking in India and before we had sort of continued cases spiking in Brazil and other places in Latin America. And of course, before this sort of resurgence that we're seeing around Asia and in Africa. And if you look at the light blue line, that is the trend growth. That is the growth rate we had prior to the pandemic and the level of global GDP we would be at if the pandemic never occurred or another recession never occurred. So that trend growth. Of course, the dark blue line is what happened. It is the pandemic. The dark blue dotted line is if we just keep growing steadily from here, although most economists, myself and Ellen included, forecast that we will have an acceleration of growth this year and a little moderation next year, and that surge in growth, that's the green dotted line, is predicated on an assumption that we will make progress against the virus and that we'll reach that trend line. But of course, I think it's important to note that if the virus reasserts itself, and in the parts of the world where the virus is reasserting itself, the trajectory is actually that red dotted line. So much worse outcomes if the virus reasserts itself. And if we look at the next slide, what we'll see is there's starting to be a divide between emerging market economies and developed market economies. And if we look at the next slide, what we'll see is the main reason for this is the access to vaccines. So if we look at high income countries, right there, they're having a much higher rate of success in vaccinating of ordering vaccines and vaccinating their populations. If we look at upper middle, lower middle, or low income countries, you can see that those are all below the global average, and that we don't see much progress, right? So for the low income countries, we're actually seeing declines as the averages move up around the world. And so that gap is widening even further. And this is really an important problem for companies, of course, and for developed market economies. So I was quoted in a Neil Irwin story in today's New York Times that really talks about why it is so important to make sure that we get vaccines out to the rest of the world. And it's important for humanitarian reasons, of course, but it's important for developed market economies that the world gets vaccinated because we have global supply chains. If we look at the next slide, we can see that growth has been varied around the world. And again, because of what's happening with the virus. So we had a resurgence in Europe in the beginning of the year. And you can see that the quarter over quarter changes, if we go to the next slide, in the European economies were negative, or in the case of Italy, pretty much flat. I should note, and I think everybody has become acutely aware of this over the past year when we've had such significant changes in GDP and output, both on the downside and the upside, that different countries report GDP in different ways. The US and Canada report quarterly GDP on a seasonally adjusted annualized basis. The reason for this is because GDP is normally trending. The subcomponents of GDP are trending indicators. And so this seasonally adjusted annualized rate tells us what the trend is. That's really useful in normal economic times. It's absolutely not useful during a pandemic. And so we also look at quarter over quarter, which is how most of the OECD reports their GDP. And then many emerging markets report year over year. And this is normally very similar to seasonally adjusted annual rate. However, not when you have significant base effects like China had, for example, in the first quarter, right? So we can see that the seasonally adjusted annual rate for China was 2.3, the quarter over quarter 0.6. So that's the first quarter of 21 over the fourth quarter of 2020. But because the first quarter of 2020 was when the pandemic hit China, that year over year GDP number at 18.5 looks shockingly large and is actually quite misleading. So we can see that there's really varied growth around the world in response to the pandemic. If we look at the next slide, we can think about the response to the pandemic, the fiscal and monetary response, as resembling a firewall. So in fire science, there is something called the fire triangle. So in order to have a fire, you need fuel, you need heat, and you need oxygen. So a good firewall is going to cut off these three elements of fire and create that firewall. And likewise, to have a recession, you really need three things. You need business exit, you need income loss, and you need financial intermediation impairment. And we really made sure that these three things were minimized by the targeted fiscal and monetary response that we deployed here in the United States. So if we look at the next slide, what we'll see is that compared to other recessions, this has been a very, very different recession. So really the impact was limited to the amount of employment decline. So if you look at the next slide, what you'll see is that while employment declined, things like average weekly hours worked, average hourly earnings, real compensation per hour, those actually all remained pretty solid during the pandemic. And again, that's in part due to compositional effects and in part due to the fact that the demand for goods remained high. And if we look at the next slide, we can see why the targeted fiscal assistance really helped provide income support. If we look at the next slide, we'll be able to see that. So real personal income with transfers, that's the dotted line, that rose significantly due to the stimulus checks. In a normal recession, this is something that would decline significantly, right? And so we can see that that really helped prevent economic scarring for a number of households. And if we look at the next slide, we can see that that effect that I was speaking about, where services and goods consumption deviated from normal patterns. So in a normal recession, services consumption merely increases at a slower rate. So it doesn't outright decline usually, and that's because we continue to go to the dentist and we continue to get our hair cut, even if there's a recession happening. But during this recession, of course, we couldn't do that. Those services were closed. Once they reopened, they weren't at full capacity. Many people were still nervous about doing that type of thing and really put off many aspects of services consumption that they would normally consume in a recession. In addition, other services like sporting events, restaurants, weddings, large gatherings, concerts, etc. All of those were really put on hold, and in many cases, in the terms of large events, are still very much on hold. And so there's a lot of services consumption that just couldn't happen during the pandemic. And if we look at the next slide, we can see the exact mirror opposite with what happened with goods. So in a normal recession, and just to go through this slide, the past recessions are all in light gray. So that's all past recessions. Going back to World War II, the light blue line is the global financial crisis for comparison. And then the dark blue line is our current economic pandemic. And so what you see is that goods consumption did fall initially, but then it rebounded very quickly. And unlike prior recessions where goods consumption usually declined significantly, we actually saw a pretty big rebound. And then in some cases, a surge in consumption for various goods. That surge in part is why we're seeing some shortages that we'll go into later. If we look at the next slide, we're going to unpack the inflation situation. So let's go to the next slide. When we think about inflation, I think it's important to contextualize. So of course, the target inflation rate is 2% for the Fed, and that's an average inflation target. They want to see inflation average that over a period of time. And then of course, trend GDP growth is the sum of the growth rate of the working age population plus the growth rate of productivity. And that puts us at about 1.8%. So if we were to hit the bullseye, right, we would be at perfect equilibrium. Of course, I always call equilibrium the mythical beast, right? We hit it for a period of time, but we're rarely ever there for very long because we live in a dynamic world. But nevertheless, it's an important anchoring concept. And then from here, of course, we can move into these other buckets. I think it's safe to say that we are having stronger than expected GDP and inflation that's in line with a lot of expectations, in part because of the base effect. So last year prices fell, but in part because of some supply constraints and this enhanced demand that we see for goods throughout the economy. And so there is a debate raging right now. Are we going to be in this cost push inflation, supply side shocks? Will that last long enough to keep inflation high for a period of time? Or are we sort of in this demand pull inflation where we have rising real wages that likely gives way to the types of investment that tend to enhance productivity? And that's really the main debate about inflation in the economics community right now. If we look at the next slide, we can see this inflation expectations in the near term anyway, usually rise with commodities prices. So if we go back to the global financial crisis, you can see that first spike in inflation expectations, 1 year inflation expectations to 5.2%. And that is when the Fed initially went down to the zero lower bound, and there was concern that this was going to ignite inflation, with a deep misunderstanding for what happens when you have debt spirals causing deflation. Then, of course, as commodity prices rose, we again saw this concern about near-term inflation that was short-lived, as the commodity price spike was also short-lived. And we are sort of having that redux right now, right? We're seeing a spike in commodity prices, short-term inflation expectations are moving higher, and even 5-year inflation expectations are moving a little bit higher. That doesn't mean that they're going to keep moving higher, however. So if we look at the next slide and unpack the data a little bit, one of the things that's hit the news, of course, is the jump in used car prices. And this is the used car price index. And I show it to you to illustrate that, unlike most other indices that we look at around different components of the consumer price index, used cars don't trend, right? They don't trend higher over time. They don't trend down. They're not flat. They move in this cyclical pattern. And so we would expect them to start trending down once the demand for used cars begins to abate. We've seen a lot of car purchases. Many economists would argue that we pulled forward car purchases into the last year, and that's going to soften going forward. And so we really don't expect this to be lasting. We expect it to be what economists would call transitory. Now, I think it's important to note, transitory does not mean it's not disruptive. It just means that we're not in necessarily a new inflation regime over the long term, and that we expect these prices to come down probably in the next several quarters. So let's go to the next slide. Here is that goods versus services situation playing out in the CPI components. So here we're looking at what we call core goods and services. That's goods and services excluding food and energy. And you can see that spike in core goods prices, which only makes up 20% of the CPI basket, and then a rise in core services prices, but a rise that is less pronounced than the rise in goods. Let's go to the next slide. So if we unpack the three components of services, transportation, medical, and shelter, we can see that medical services were rising prior to the pandemic. So here we've indexed back to 2019 because there was so much noise in the 2020 period. And we can see that transportation prices, while they fell heading into 2020, and then of course during the pandemic, are now coming back up. But when we think about this average inflation targeting, right, over longer periods of time, we can see that while transportation prices are rising now, that people are beginning to go back and demand transportation services, they're not rising compared to, for example, their pre-pandemic levels. And then, of course, shelter is increasing at a rate that's pretty commensurate with overall inflation. And we'll see what happens to medical care. This is always a bit of a wild card, but it's also not terribly highly weighted in the consumer price index. Let's go now to producer prices and look at the next slide. So you can see, again, very pronounced, this goods versus services component, right? And goods makes up 32% of the producer price index. You can see it rising much more than producer services. And again, something that we expect will be transitory and will abate. Let's unpack two of those components. Looking at the next slide, we'll look at lumber prices, again, very much in the news. And lumber prices really have been a victim of the Trump tariffs. In 2019, we can see on this left-hand graph, the decline in employment in Canadian lumber mills, which started right after the tariffs on Canadian lumber were put in place. They continued and accelerated during COVID. And then in the face of rising US demand, which we can really see on the right-hand graph, which shows exports of Canadian lumber to the United States, we can see that employment in Canadian lumber mills coming back up. We expect that to continue to rise and for supply to continue to expand. We're already seeing lumber prices down from their highs, and we expect this to normalize over the next 2 to 3 quarters. Let's look at semiconductors next in the next slide. With regard to semiconductors, there's a lot of talk about how we have this global supply chain for semiconductors and we need to produce more semiconductors. But you can see here, these are our imports and exports of semiconductors. You can see that we export, that is, we produce here domestically and sell abroad, just about as many semiconductors as we import. The question is, what kind of semiconductors? And the problem with the pandemic is it caused a shift in the type of semiconductors that firms anticipated would be demanded. So as a result of 5G, there was a gearing up to make semiconductors which met 5G demand. Of course, we did not see that 5G demand materialize, and instead what we saw demand for semiconductors that go into a variety of different home electronics and automobiles, and the supply chain just wasn't prepared for that surge in demand. So if we go down to the next slide, we can see that the firm response to this is that they are preparing to raise selling prices. So they are planning to pass on a lot of these possibly transitory price increases to consumers, right? So this is the National Federation for Independent Business, and the percent saying they're raising their average selling price, or they plan to raise the average selling price, are at levels not seen since the global financial crisis. And I just want to point out that you can see, of course, that shortly after we reached the last peak, then we saw a lot of firms planning to not increase prices and some planning to decrease prices. So again, I would say, while disruptive, more evidence that this is likely transitory. And finally, if we look at the next slide, what we can see is that if we think about this average inflation targeting, and we look at the time period just prior to the pandemic, so the trend is represented by the light blue line. That would be 2% CPI growth. The actual is what happened to the index, and you can see we fell below that 2% trend. The data that we're getting likely later this week and that we got last month are going to push us above that 2% line, but they're not going to keep going above month after month, right? We're expecting to level set above this trend and then move up in line with the trend growth over the next several years. And so given the Fed's new inflation targeting regime, if this is what happens, this is perfectly consistent with their goals, and it will free them up to really focus on what's happening in the labor market and focus on making sure that we get back to full employment with a participation rate that is commensurate with pre-pandemic levels. So now let's skip 2 slides ahead and look beyond the pandemic, and a little bit at the labor market. So economists have talked about this K-shaped recovery. And a big component of what's happening with regard to inflation is, of course, what's happening with jobs growth, what's happening with wage pressures. And we can see that if we look at the top leg of that K, that's people that have been able to work from home. They've largely retained their jobs. And the unemployment rate for those workers is only 2.7%. This is really significant. And what it suggests to me is that there may well be wage pressure in the upper leg of this K. And that comprises about 40% of the labor force that can work from home. If we look at the bottom leg of the K, this is those workers that must work at their job site. That's about 6.5%. That unemployment rate is about 6.5%. Now here you would anticipate that there's a lot of slack, that therefore the wage pressure would be significantly lower in this portion of the labor market. Instead, what we're seeing a change in what economists call people's reservation wage. And interestingly enough, this has happened historically. In all previous pandemics, we see a higher share of labor income after the pandemic. Now, what the literature has assumed is that this was because of the death rate causing a lot smaller labor supply, and therefore then higher wages to labor. But we're beginning to examine if there isn't also a change in preferences that pandemics also induce, causing people to be a little bit more picky about where they work and under what conditions, and of course then demanding a higher reservation wage. And so these are really significant possible changes and details of the labor market that firms really need to start considering in the year or two ahead of us as we emerge from the pandemic. Let's look at the next slide. one of the key things that we are hypothesizing that is preventing people from going back to work is the vaccination rate. So at the time of the last unemployment survey, the employment survey, 48% of adults had not received even one jab in the arm. We're now down to about 42%. And at the time that the next survey is taken, we anticipate that we will be below 40%. So as the number of people that have received at least one shot and the number of people in the working age population I'm talking about that have received at least one shot, the more likely they'll be to go back to work. Perhaps their reservation wage will adjust down slightly. And so we're expecting many of the frictions that we've seen in the labor market to dissipate over the course of the next several months. Let's skip 2 slides ahead. So despite this, we do see firms, or I'm sorry, because of this rather, we do see firms really saying that they're having difficulty hiring. And this is another sort of conundrum. We think it has to do with this vaccination rate. We think it has to do maybe with some of the unemployment insurance benefits. And we think that it has to do with sort of changing worker preferences. Going on to the next slide. Nevertheless, we do think we will get back to full employment and pre-pandemic trend levels sooner than we did coming out of the global financial crisis. So you can see that coming out of the global financial crisis, it took a long time to get back to the pre-crisis trend levels. And we do anticipate a faster recovery this time, that there are frictions and that those frictions will remain for at least another year or two, but that we will see a faster return to full employment. So let's skip 2 slides ahead. Let's go down one more slide, please. So one of the things that we have seen is historically, when we have long expansions, what we see is that federal tax receipts as a percent of GDP tend to grow. And in part, that is because of capital gains taxes. Long expansions tend to be commensurate with rising asset prices. And of course, as people reallocate portfolios, they pay taxes on those assets, and we see higher government revenues. That did not happen during the post-global financial crisis long expansion, in part because the Tax Cuts and Jobs Act reversed that action. And so we were in perhaps an unsustainable fiscal situation prior to the pandemic. We had budget deficits of about 5%. Coming into the pandemic, of course, we used fiscal policy to prevent economic scarring. And the theory here is that we are going to be able to have stronger growth coming out of this. The previous slide, which showed that recovery in the jobs market much more quickly than coming out of the global financial crisis, is really significant for a number of factors within the US economy. So let's look at the next slide. One of those key factors is what happens to productivity. So coming out of the global financial crisis, we had subpar capital investment, we had subpar productivity growth, yet we had lots of technological advances. And those technological advances were not widely diffused throughout the economy. One of the things that the pandemic has done has shocked firms into adopting technologies, and it has pushed this diffusion out in ways that we did not see prior to the pandemic. Sort of necessity is the mother of invention. So if we look at the next slide, what we can see is a very sharp increase in information processing equipment. So information processing and software investment went up as a percent of GDP. We're near the peak seen in the late 1990s. And of course, we know the 90s was a very significant period for growth in productivity. If we see continued investment over the next several years at these levels, we think that is very supportive of a productivity gain coming out of this recession. Let's look at the next slide. We're going to need Capex, though, to elevate here across the board. So of course, we saw a spike in response to the Tax Cuts and Jobs Act. It was not sustained. We're going to need to see sustained higher Capex. But if we get that, let's look at the next slide. So I spoke in the beginning about potential GDP, potential GDP is the sum of the growth rate of the working age population plus the growth rate of productivity. And again, we assume that to be about 1.8%, 1.5% productivity, 0.3% working age population. But if we look at the next slide, we can see what the possibility might be if we were to have even a 75 basis point increase per year in productivity. That would take us to a potential GDP of closer to 2.6%. And really, it would mean a very different dynamic, both fiscally and economically, for the next decade or so. And part of our thesis around this is what I enunciated before, this sort of push of technological diffusion as a result of the pandemic. We also have pent-up savings that is being invested, that is being spent, that will again hopefully be an impetus for firms to continue with Capex. Similarly to World War II, right? We've had a shock to our economy that's been very, very significant, very severe, and very negative in many ways. But because we are anti-fragile beings and our economies are anti-fragile organisms, sometimes they derive strength from stressors. And so the example of technology diffusion is one such strength that's being derived from this stress of the pandemic. So if we go to the next slide. Let's go to the slide after that. We can see that our expectation is for fairly strong growth. We're looking for a 6.7% growth rate for 2021. And unlike some economists that really expect that to fade back, we expect there to be a slow trickle out of savings spending. So 5% growth in 2022. And if we're at our new potential GDP, let's say of 2.5%, this is still above potential GDP. Obviously, we're significantly above potential GDP if we're at the old potential GDP of 1.8. And we expect this above potential GDP to continue into 2023, again, driven by investment, consumption, and a more normal distribution of consumption between goods and services.